Today is Monday, August 14th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADMIS's Senior Financial Economist. Steve, let's start with the grains. What were the results of the August USDA report, and how did the market respond?
It was a bearish report. The USDA NASS group came out with yields higher than expected, and their explanation was that the farmer survey, that's half of the numbers that they use to come up with yields, was much more optimistic than they thought. So now we've got a tour next week with Pro Farmer that's going to go out there and see if those numbers are correct. As far as big picture, number one, they're showing increase in global demand. So that's a good thing. Number two is that we're going to continue to see drop in U.S. share of exports, which is a bad thing. As far as the world data is concerned, corn stocks are a little bit lower, but stocks usage is near historical lows. Bean stocks are record high, but stocks to usage is also near record high, and we just have too much wheat.
So where does the market think prices may go from here?
Well, right now it's interesting that the market is looking for USDA says the average farm price of wheat will be $4.80. Last year was $3.89. Beans $9.30 versus $9.50, and corn $3.30 versus $3.35. But some of the private people say, if you look at beans, we're going to trend lower and make March lows around $8.25 on the futures, which would put meal at $260 a ton. As far as corn is concerned, I think we'll make a December low, somewhere around $3.40 to $3.50 on the futures. And then wheat, we've already put a low in, but we may not go very high because of the large world stocks.
Let's talk weather, Steve. What's the forecast for the rest of August?
It's interesting in that for the next week, it looks like it's going to be wetter than what we've seen in the last month or so, especially on the heart of the Midwest. And right now we're looking at maybe some colder than normal temperatures in the month of September, but it looks like a normal harvest. And the only other thing that we can look at right now is that the early guess for South America is no problem for their crops in 2018.
And when is the next USDA corn and soybean outlook update?
Well, they have monthly reports in September and October, but I think the key will be looking at what Pro Farmer says next week.
Alan, I know you like to look at copper as one of the markets which gives us clues about the global economy. Last week, copper futures advanced to a 26-month high. What does that tell us?
Well, basically it says that the global economy is in good shape. We're probably going to see our GDP in this most recent quarter coming in better, in fact probably much better than the previous quarter's number. So the global economy is, I think, going to do quite well. I think it's inflationary, and it also means that the gold market can probably continue to advance if we're right that inflation is likely to be ramped up with a stronger global economy.
We did have weaker than expected producer and consumer price index reports last week. Does that change your outlook for the Federal Reserve policy?
To some degree, but we were always in the camp that the Fed was likely to be rather slow to raise rates. So right now the probability that the Fed will raise rates at the December meeting is now just at 40%. And about a week and a half ago it was as high as 50%. So we're looking for no rate increase this year, but I think there's a very good chance we'll see a 25 basis point hike in rates from the Fed in the first quarter of next year.
Alan, last week the S&P and Dow came under some pressure after making some new historical highs early in the week. This sell-off was due to geopolitical issues, specifically the tensions between the U.S. and North Korea. What is the outlook for stock index futures, and how do you think the market will react if the rhetoric between the two countries continues?
Well, today it seems that there is a bit of an easing of tensions, so we are seeing good gains across the board in all of the indices. From time to time, we have seen geopolitical events put a temporary dent in the bull market, but I want to stress the term temporary. Every time we've had a situation of various kinds that set back the indices, each and every time we came back to making new historical highs. And I think that is, again, going to be the case this time. So I'm predicting within the next couple of months, we'll see another new round of historical highs, record highs in all of the indices. So buy every break that we see in the index futures.
And you mentioned to me last week that the currency markets are the best barometer when measuring geopolitical effects on the markets. Can you explain that a little to our viewers?
Well, basically, the currency traders have two sets of fundamentals to look at. They have the fundamentals of what's going on in the U.S., but they also have to look at what is going on elsewhere in the world, for example, in the Eurozone. So traders have to look at what's happening in the U.S., what's happening in the Eurozone if they're trading the euro currency. So whatever happens on a geopolitical basis globally, always look to the currencies to give you the correct decision as far as what the markets are actually thinking and the severity of any geopolitical problem.
Steve, the energy markets are pretty quiet right now. Year over year here in the U.S., we're paying about 20 cents more at the pump on average than we did last year. Is there anything worthwhile to discuss in the energy complex?
Well, following up what Alan said, we've seen a rally from $44 crude to $50 crude on optimism not only in the global economy, and that could increase demand, but also that maybe OPEC can get their act together and reduce global production. At $50 a barrel last week, we ran into some headwinds. Number one, U.S. oil rigs is up year on year. Number two, the EIA U.S. monthly crude production was up for the third month in a row. And then we had these unrest between U.S. and North Korea. I think most analysts feel that a bottom is in at that $40, $45, and that if the economies can move higher, that's going to push crude oil prices higher. Now, the only thing that we have is that the funds have a big long position in crude oil. So we're kind of dancing around some conflicting inputs, but in general, it looks like energy prices should go higher.
All right, remember the news and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.